Welcome back to the channel. Today we're going to talk about FHA updates and some information about FHA loans. So thank you so much for tuning in. A question that's come up for me very frequently, and I thought, well, this is a good video topic, is FHA and its mortgage insurance, which a lot of people say PMI. It's actually MIP on government loans, mortgage insurance premium. And there's a lot of confusion around this. So let's start by talking about the MI, okay? The first thing is there's two pieces to this. FHA charges an upfront and they charge a monthly. So upfront is 1.75% of your loan amount. Most people choose to finance it into the loan. So even though you're putting down 1.5%, you're on top of that, 3.5%, you're actually financing 1.75% in a funding fee. So a lot of that is really going toward that fee and not all toward the down payment. Just keep that in mind. So as an example, on a $200,000 loan, 1.75% is $3,500 financed in. On a $415,000 loan, 1.75% is going to be $7,262 financed in. There's also 50 cents, but they don't finance in the change, so you'd be paying the 50 cents in cash and financing in the rest. Now, that's the upfront, and you've got the monthly. Now, the monthly, it actually is on a sliding scale, but it's not much of a sliding scale, and most people that go FHA do tend to put down the minimum down payment, and that scale more applies to the larger down payment and or the shorter mortgage term. So here's what I mean by that, and I've got the FHA guides pulled right up on this. So if you are doing a FHA loan with 3.5% down, your mortgage insurance calculation is going to be 0.85%, and it's going to be for the life of the loan. That's where most people fall. What in the world do I mean by 0.85%? All right, let's take a $200,000 loan amount, not 20 million, 200,000. That's $141.66 a month in that example. 415,000. That's $293.95 a month in that example. And again, 85% calculation and for the life of the loan. Now, there are some exceptions to that. As an example, if your base loan amount is less than or equal to $625,500 and your LTV is less than 90%, then your mortgage insurance calculation is going to be 0.8 instead of 0.85, and you will have it for 11 years, not for the life of the loan. So keep that in mind, because that's if this then that, right? So let's do another calculation. Let's say if your loan amount is greater than $625,500 and your your LTV is less than 90%, your MI actually goes up and is based on a 100 calculation, not a 0.80 and not a 0.85, and it's for 11 years. So it's actually increased when that loan amount goes up, and you're like, what? That's so aggravating, I'm sure. Another example is greater than $625,500 and over 95% LTV, then it is a 105% calculation, and that is for the mortgage term or for the life of the loan. So very important to note. Now, let's say if you're looking at a term equal to or less than 15 years, which some people do, but most people don't. That's another example. When you're below the $625,500, if you're less than 90% LTV, your mortgage insurance, which you still do have, is 0.45% instead of 0.85%, and it's for 11 years, not for the life. Now let's say if you're above 90 LTV and you are at a 15-year or less loan, then it's 70 instead of 0.85, and it's for the life of the loan. So, and there are some other criterias and things like that. As you can see, there's a lot of if this, then that. So when someone tells you that if you go FHA, you pay mortgage insurance for the life of your loan, they're not true. If there's a lot of other information that goes into that to determine that factor. If someone tells you that if you have an FHA loan and you have 20% equity, you can get the PMI removed, that's also not true. It's not the case. They may be thinking of a conventional loan. And that's what happens a lot, and why there's so much misinformation is it's partial truths, and people don't mean bad at all, but they just don't know what they're talking about, right? If it's conventional, it's one set of rules. If it's FHA, it's one set of rules. If it's this LTV, it's that set of rules. If it's this credit score or this mortgage term, it's that set of rules. It's so specific. And that's why if mortgage lending was so easy, everybody would do it. But it's actually really complicated, and it's difficult, and it's very, very, very case specific, even when it comes to any loan. And in this case, today's video would be FHA loans, as to what you're going to be looking at, what you're going to be qualified for, and what things are going to cost you specifically, including things like your loan amount, as we saw by looking at the FHA chart. Now, if you want to go look at the FHA chart, you probably don't, because it's a little confusing and not what you do every day, but you would want to look at the FHA MI chart, and you would want to pull up the chart from HUD.gov, not any of these other websites that are trying to actually sell you something. What I find in my experience is that an FHA mortgage is good for people who maybe have average credit or below, who maybe have less than 5% down, who maybe have a higher debt to income ratio. Those are people that tend to fit in the FHA box, because FHA is more flexible on those types of things. So if you want more information on FHA loans or any other kind of loans, my name is Stephanie Weeks. I've been a loan officer for 18 years, and I would love to talk to you about your financing. I'm at 985-300-LOAN or weeksteam.com. Please be sure to check out my other videos. I'm going to drop a link in the description below to a free copy of my book, Mortgage Peace, and I look forward to seeing you in the next one.